All right, welcome back, everybody. So, what we're going to talk about is what is an efficient stock market? Everybody's heard the term. I know. Let's talk about what an efficient stock market is and then what it is as I've come to understand it. So, I'm going to grab my phone and I'm going to read directly the definition of an efficient market. So, the efficient market hypothesis is a hypothesis in financial economics that states that asset prices reflect all available information. A direct implication is that it is impossible to beat the market, in quotes, consistently on a risk adjusted basis, since market prices should only react to new information. So let's just put that in very simple terms. Effectively, the market is acting right now based on information that it has already absorbed. Therefore, there should be no adjustment in behavior or price or volume or anything unless there is new news released. That would make a lot of sense, wouldn't it? That would make a lot of sense. Now, let me tell you the problem with that efficient market hypothesis. I have been forecasting for a decade. Okay. I am very accurate. Feel free to follow me and have a look. I am very accurate. There are many men. I am not some wizard. There's thousands upon thousands of men. There might be more than thousands for all I know around the world that are able to forecast markets, make money, big money consistently every year. Let me tell you what I believe an efficient market is. Okay. An efficient market, and the way I know best to judge an efficient market is this. When you pull up a chart and you see bars are representing price, obviously, right? So bars on the stock security index you're looking at represent price. When you start seeing big long bars and they're basically going straight up and you're looking down at the bottom and you're seeing big giant volume, I can tell you that on a very consistent basis, and I mean very consistent, 80, 90, 95, 98%. When you add a couple other variables to what I'm saying, you're in the high 90 percentile that price will revert to where it took off from. Therefore, if the market were efficient, things like that would not occur because the market would be reacting to some new piece of news. The other thing that blows the efficient market hypothesis out of the water is the news itself that they're talking about. 1 week, high oil prices is great for stocks. The next week, high oil prices are killing stocks. 1 week, inflation's amazing for stocks. The next week, inflation's destroying stocks. The same goes for war, energy prices, GDP, onward and onward and onward and onward we go. If a market was efficient based on information, that would effectively mean that markets moved on fundamentals alone. Now, let me just throw something at you all, and I know that you all are well aware of this. I'm not talking down to anyone, and I know it. I'm not telling you anything you don't know. Is there anyone here alive, breathing with a brain that believes real estate prices in 2020, starting in 2019, and then rolling through 2000, what, 22-ish, were really homes were really worth 40% more? Is there anyone that believes that? If you believe that, I want you to turn me off right now. And I also want to warn you that you're going to get sold ice from Antarctica, and it's going to be pitched to you as mansions and you're going to buy it, because that's ridiculous. If you actually believe that a home value, it became worth more based on some fundamental basis, the lumber was all of a sudden worth more, your roof was all of a sudden worth more, your location was all of a sudden worth more. And by the way, it wasn't just in one or two areas, it's everywhere. Let's talk about what really happened. Well, we can't talk about what really happened, but let's talk about what we were told. COVID happened, a lockdown happened, and then there was a COVID relief fund. And what happened in 2021 is we put 50% more US currency in circulation that was already in circulation, something I've personally never heard of in my life. What is that? What does that really mean? It simply means we took piles of money, big, giant, monstrous piles, and we pushed them into the economy. Now, what happens when you do that? The result of that action is that everyone has more money. Corporations have more money. In fact, they get more than everybody by a long shot. Individuals have more money. Businesses have more money. That drives prices up. Why? Because you have more. If you're in an auto auction and your favorite car's in the auction block, it doesn't matter what if the thing is worth 6,500 and you have 5,000. It doesn't matter how much you love it. But if the car costs 6,500 and you got $10,000 in your pocket, guess what? That car is getting sold for 10 grand. You know why? Because you really want it and you really have $10,000. That is all that happened. And that is not an efficient market. That is cash flow manipulation. There is no difference in that. Cash flow manipulation is the same cash flow manipulation that happens when big money, institutional money, pumps dollars after an index, a commodity, a security, whatever. When it pushes money in those directions, those companies don't have to be worth more. Anybody here remember Krispy Kreme? I do. And soon we're going to be saying that about NVIDIA. We're already saying that about SMCI. We're saying that about a lot of things. It happens all the time for anybody that plays in the markets. So then when you remove that money, and everybody in the back there, let me know. When you remove the money that you put in, what's going to happen to price? Price is going to drop from whence it came. And you have to remove the money. Why? Because you don't have any more money. And in the case of inflation, you don't have the money to pay the interest. And since the goal of inflation is to break the consumer, therefore drive prices down, you effectively, if inflation's goal is to make you so broke you can't afford your life. That's the point. There is a soft landing. And this is all very easily understood, right? So, an efficient market, as I've come to understand it, is this. The efficiency of a market is that where the cash flow is, where it's being directed and where it's being redirected, where it's being put in and where it's being taken out. Because the fundamentals, we talked about it. Lumber wasn't worth more. The roof wasn't worth more. Your location wasn't worth more. It was a matter of money being pushed into a market. That's it. The stock market, the commodities market, the futures market, the options market, everything works the same way. If there's a bunch of guys out there pushing money here, pulling money there, pushing money here. You just have to know where they're pushing the money and where they're pulling the money. Because that's going to create price appreciation and price depreciation. And that, after 20 some odd years, is how I've come to understand an efficient market. An efficient market is a market that's running on cash flow because nothing else really matters. Hey, listen, I hope you liked the video. I hope it made sense. Please like, comment, subscribe, all the stuff, whatever. I love the support. I'm making these videos to share the knowledge that I've attained over the last couple decades. And I love doing it. So hopefully it turns into something more. All right. Thanks so much. If you have questions or comments, please reach out. Outside of that, I have a pretty cool video coming next. So stay tuned.